Hey there, everyone. This is Dave Dubeau. Welcome to another episode of the Property Profits Real Estate Podcast. Today, it is my pleasure to interview Mr. Glen Sutherland. Glen, how are you doing today?
Thanks for having me, Dave. I'm excited.
I'm excited to have you here. So if you're not familiar with Glen, you should be, because Glen is a fellow podcaster. He's been doing this quite a bit longer than I have, so he's got a very, very interesting podcast all about Canadians investing down south, the Canadian invasion down south, buying up American real estate. So that's very, very cool.
Yeah.
I'm excited to chat with you about that. And just let me know, how did you first get involved in this crazy world of real estate investing in the first place?
From the very start. Well, my parents owned a duplex, so I grew up being the labor. But I guess that's how I got into the idea of doing real estate. And then, I guess it wasn't until I was, I guess 2011 is when I looked it up beforehand. And 2011 is when I bought the first property. And it just went from there. One turned into two, turned into three, turned into four, and it started multiplying. And then once I got comfortable, I had a tenant that moved to Strathroy, and it was the greatest tenant I've ever had. I still have to this day. And once I got used to having a distance of, for me, that's about an hour and a half, hour and 45 minutes from the tenant, I was I was ready to go see how far I could go. And so I'm like, do I want to invest in Alberta? Do I want to invest in New Brunswick? And which are both great markets, but I ended up pulling the trigger with the States and ended up moving my business down there. I still have Canadian real estate, but I'm mainly buying down there now.
All right, but you're still based in Canada. Where are you calling in from today?
I live in Cambridge, Ontario.
Okay, great.
Yeah.
Very, very cool. So that's quite so you were like most of us. You just got smart about it. Most of us think, we have to invest within an hour of where we live. Unfortunately, that's not always the wisest choice, because a lot of people live in really crappy real estate markets. There's probably a way to make money in any market, but some markets just a hell of a lot easier than others. So transitioning further afield and then transitioning out of country and down to the States is quite adventurous. So tell us a little bit, what kind of deals do you focus on down in the States? Are you buying single family homes, multis? What kind of markets are you looking at?
So different than markets, but what I'm mainly buying is single family. I do have some duplexes, but I mainly focus on single family homes. What I'm looking for in a property is that it has the ability to ideally refinance out of it. So if I really want properties that if I can buy them after a renovation, then I can get all of my money back. The biggest thing is that you run out of money. I don't care if you have like $10 billion. Eventually, if you just go buying, if you had that kind of money, you'd be buying huge apartment buildings. But eventually, you'd run out of money, no matter what. So it's the way to keep going is to be able to recycle your money. So that's what I'm mainly looking for. And I'm doing a lot of joint ventures now. And to do that, ideally, you want the joint venture to get their money back. You want them to get their money back. You don't want them to have their money stuck in there. It's a lot harder to sell something if you're going to say you have to keep it in here for 5 years. It's a lot sexier to say I only need it for a short period of time and you're an equity partner. So that's
right. You continue to hold ownership in the property. Okay, so you go down to so what kind of how did you decide what market to start with in the first place?
Oh, right. Yeah. So I got a bunch of criteria and I started cutting down markets, because there's really if you start listening to the podcast of the Americans, you'll notice that there's a lot of the same people in the same markets that keep getting mentioned over and over again, because they're just really well positioned. So I started out with the whole list, which is 30 different cities that I was interested in. And then I went because if I'm going all the way from Canada, I'm going to try and pick the best that I can possibly pick, right? So then I went, which ones, sorry, I lost my train of thought. Which ones are landlord friendly, right? So if I'm going to leave Ontario a tenant friendly province, I want to go, that's what I was striving for, right? I want something that's going to be in my favor if I have to do an eviction. So then I went through and cut the list Only a few off, actually, because a lot of the big and other investors are always going for the same sort of states. Mind you, there's still other ones that spread out. And it's not necessarily, I wouldn't say that everyone has to do it that way. But, because if you're used to Ontario, then you can go to other place and you'll have the same problems, but you might have some different cash flow. So anyway, total tangent. I'm really good at that.
That's all right.
But anyway, so I did that. I was looking for populations that were growing. So I wanted growth. I wanted a lot of large businesses coming into the markets. I wanted investment, and like the markets I've picked have been heavily invested by Trump. So right now they're building like new car plants and new Amazon, and stuff is coming in. So
I wonder if that's a coincidence.
Yeah. So even if I buy this all wrong, which I'm not, I'm buying everything off market, or if it is on market, it's usually a foreclosure because those are listed. But I'm buying off market, so I am getting good prices on the properties. But say I still bought this thing wrong, I want a market where the market will bail me out. Because when I started in Ontario, I didn't really know what I was doing. I didn't know how to figure out what I should be charging for rent. And because of that, I should have lost a lot of money because I wasn't buying properly and I wasn't renting for as high as I should be renting. But the market took off, and it didn't matter what you bought, everybody won. So it all worked out there. But that's, now that I'm in the States, I want to have that sort of backup cushion as well.
Right.
Yeah.
Yeah, that makes a lot of sense. Okay, so you got different markets that you're investing in. You dialed it in. You found what works for you. So a lot of people are probably wondering, okay, well, that's cool. It's kind of scary, though.
Yep.
And the limited amount I know about investing in the States, one of the hurdles I see Canadians having is, how do you get set up properly with legal and financial and accounting structures so you don't get double whammied with taxes? And I know that's way too deep to go into in depth in this conversation, but can you give us maybe just a little overview of how you're set up?
Super quick overview. First of all, get an accountant and get it set up properly. Because you can set this up yourself. But
most accountants don't know how to do the cross-border thing.
Yes. So get a cross-border accountant. My accountant, that's all he does is he's in the States, and he just does people from Japan and China and Canada and Australia that invest in the States. Yeah. So he specializes in that. But what the main thing is that you don't want to own just a basic LLC, which is a limited liability company. You don't want that because the way it's a flow-through company, which doesn't exist in Canada. So if you don't actually pay taxes in that company, it flows through to your personal return. Yeah. The problem with that is the way Canada Revenue looks at that, and they say, well, that is a corporation, so we want to tax the corporation, but the money is all flowed to your personal return. So then they want to tax you personally as well, and you're going to get double whammied. Yeah. So the ways around it are using a C Corp, like a full-on corporation, or using a limited partnership. And even if you have a limited partnership, you can stagger LLCs underneath because they're nice and cheap to set up, and it limits the liability from from property to property, or you want to bundle them together. And it's just a way to separate stuff and mitigate your risk. But in all honesty, you want to set something up. You don't want to be owning this all in your risk, all in your own personal name. It's a lot of extra risk because no offense to Americans, but they do like to sue a lot more than we do.
Yeah, and we're starting to like to sue a lot too. So yeah.
Yeah.
Okay, well, that's cool. Thank you very much for the overview there. Yeah. Next question I've got about investing down in the States. So am I right in assuming that you're going in all cash, buying the thing all cash, doing the renos, and then you're getting the financing after it's all set up? Is that correct?
Sometimes. Okay. Sometimes I have, I think 5 properties I own in cash right now, but what I like to do is, in all honesty, I'm bad and I like to use my own cash, or put cash into deals. And if, what I really want to do is put the 90% loan to value, get a fix and flip loan. There's tons of companies down there that do these fix and flip loans, and just make sure you get a reputable one. But a lot of them, even for a Canadian, because it's not based on credit score, actually, in all honesty, it's usually based on experience. Mm-hmm. So they may, depending on the company, use your Canadian stuff. But even I just filled out a loan today. I didn't use any of my Canadian stuff on it. But it's a lot of it's experience in the deal. And so they have fix and flip loans, which are 90% of the purchase price and the renovation.
Wow.
So you can get that. It's expensive. It's hard money, right? Yeah. But it'll get you through instead of buying the property all cash, because you're going to burn through all your cash, and gives you more projects at the time. And then you can put a small amount down and do your renovation and then refinance. And depending on the lender, they'll let you do cash out refis, and some of them are immediate, but then the rates are higher. But 3 months, 6 months, the less exciting ones are 12 months that they'll make you season the property. And seasoning the property is like having it fully rented. So the one I like, we usually can do it right away, but I end up paying a little bit higher, but that's okay with me.
All right. Very, very cool. And then, so that's good to hear. There are some good finance options down there for Canadians. Expensive, of course, but if you're doing the rental, the quick in and out kind of thing.
Yeah.
So, how often are you, like when you're doing these deals, are you having to go be boots on the ground there, checking up on everything and doing all that kind of stuff, or how do you manage that?
I go down probably every half year, but it's more to shake hands and make communications with different people. When I went down in the fall, I went and toured a whole bunch of properties, but I've found that it's not even necessary now that I have a good team. So I have my property manager, and between that and my realtors will tour properties for me, take photos, take videos, point out things, almost like a preliminary basic home inspection. And, it's not the home inspection, but they'll give me a good idea if it's worth buying. And they don't get paid for that. And the reason they do it is because they will get paid in a different way. Like if it's a property manager, they'll get paid once the property's under contract. I'll be having this long-term relationship with them renting it. Or a realtor will get paid whenever I buy the property or I sell a property. And so off the start, it's really hard because people don't want to do those type of things for you because they don't know if you're actually a closer. But once you've established a relationship, they will, if you find the right people, they know they'll get paid eventually, and it works out, and it's a big, utopia of everyone gets paid and everyone's happy.
That sounds like real estate utopia for sure.
Yeah.
So in these different markets, how many different markets are you investing in right now? How many different?
3 markets.
Okay.
Yeah,
close together, so you use the same map, all 3? No, they're all.
No, they're all over the place. I'm in Alabama and in Missouri and in Indiana. Okay. So, kind of the south, the middle, and then almost over to the east, over to the west with Missouri. But I originally, when I first started down there, I got a property manager that was nationwide, and I thought that would be a great way to be able to do this. I didn't like it. I felt like I was calling my cable company every time I called in, and I had to be directed through different people and put on hold. And I switched to people who are smaller and specialize in that market. Yeah,
makes sense. Very, very cool. All right, Glenn. Well, so I imagine how long? So what year did you start investing in the States? How long ago?
2017, not that long ago.
Yeah, yep. Not that long ago. And you're already in 3 different markets, and you're building up quite the portfolio there.
Yep.
And now that you've started the podcast and you're kind of become known as the Canadian investing in the U.S. guy, what are some of the biggest mistakes you see fellow Canadians making when they plunge forth to invest down in the States?
Well, I think the big mistake is that the numbers are different, right? They see a house that's like $75,000 that rents for $750 a month, and they're like, "Oh my God, this is the steal of my life," and they go and buy it. But they don't realize that that's actually commonplace, and they're not actually buying a deal at all, and they're buying at market or even above market, and they don't understand that because it's totally different, and it's so different that like some of these numbers, if you're not planning on holding these things forever, because if you're going to hold it forever, it doesn't matter, right? But if you want to exit from these, you're going to have rude awakening if you bought it wrong.
Yeah,
that's like if you're
not going up necessarily.
Yeah, or they're going up, but you started behind. So you bought that $75,000 property, but it's only worth $65,000, and it's going to take you the 5 or 10 years to get up to your 75.
Yeah. Okay. Yeah, definitely different market, different learning curve. Excellent, Glenn. Well, you and I both do fairly short podcast interviews, so we've got to wrap this sucker up. But if people are interested in finding out more about your podcast, first of all, how can they do that?
The podcast is on YouTube, Stitcher, SoundCloud, and iTunes. It's called Canadian Investing in the U.S. You can search Glen Sutherland too. It'll show up in either one will show up in Google or wherever you're looking for it. And so I have my website as well, glensutherland.com. I give it away for free. There's plenty of episodes where I'm just, especially episode 1, which actually should be redone because I did it so long ago when I wasn't as comfortable with the camera. But they're full of information, and it's all given away for free. And you can even contact me if you wanted to go a little deeper.
Perfect. Sounds awesome. Thank you very much. This has been great. And the nice thing about these short interviews means we can always come back later and pick up the conversation.
That sounds great. Thanks, Dave.
Thanks a lot, Glenn. All right, everybody. Take care. Have a good week. And we'll talk to you next time on the next episode. Take care. Bye-bye.
Well, thanks very much for checking out the Property Profits podcast. And if you like what we're doing here, please head on over to iTunes, subscribe, rate us, and leave us a review. Be very, very much appreciated. And if you're looking to create a regular flow of inbound investor inquiries about your real estate deals, then I invite you to attend one of my upcoming live online demonstrations. And you can check that out at investorattractiondemo.com. Take care.